Welcome to my channel. I'm Dr. Romano. Today's video is going to be about my life's past and my career and why I completed a Ph.D. Before we continue, please remember to subscribe so that you get my future videos, and please remember thumbs up, as well as please remember to share my video with at least 5 people. And finally, please remember to send me questions to the live chat so that I could create future videos just for you. Thank you. I started going to college and I didn't know what I wanted to do in my college life. After about a year, I changed to psychology. I originally wanted to become an architect, but somehow when I saw all those math classes, I said, oh no, I'm not doing that. So I forgot about architecture and I went into psychology. After 2 years of studying psychology, I realized that I was not going to become a doctor of psychology. I loved psychology because I always knew I wanted to be in business, but I didn't know what because I was so young, but that's okay. I knew I had to learn a certain amount of disciplines and educate myself on certain topics, certain majors, etc. And I knew if I studied psychology that I would understand how people think, how they react, and also how to sell them a product. I also began to take marketing classes. Marketing is so important because it doesn't matter what career path you're going to go down. It teaches you pretty much how to deal with people, how to sell a product, how to present yourself in meetings. It's all part of it. So psychology marketing was very important. After my second year, I realized that I did not want to continue on in psychology. I had taken enough classes that I didn't need to major in it. And that's what universities, they do. They force you to select a major. That was the problem. I should have been taking all the basic classes first, meaning all the college requirements. And it would have helped me a lot to know my future because I would have taken maybe an economics class or a finance class. I didn't know that I liked that. So a friend of mine, he called me up and he asked me if I wanted a job. I says, no, I don't know anything about investment banking. And of course, I wasn't finished college. I was in the middle of my 3rd year. But he said, Anthony, I would like your help. You're going to regret if you don't take this job. He didn't tell me exactly what I would be doing. He didn't tell me what company it was. He just told me it was downtown Wall Street. Now, I didn't realize it was going to take me an hour and a half to get there and an hour and a half back. That was a lot, but I figured that out very shortly. So he told me, come over for dinner, and I went over his house for dinner, and he told me what it was about. He told me, that I would be working in an investment bank. He told me that I would be doing databases, and at that time, I had studied computer science. So I kind of changed my major, but I really didn't. I was just taking computer science classes and programming and all those great classes to see if that's what I liked. And that's probably why I got the job at the investment bank. I can't tell you the name. So I started probably June probably. And I went on an interview, but it wasn't really an interview. It was more like, this is the director, meet and greet, and that's it. I had already got the job, but I didn't realize that. So on the first day of work, I enter, and it's a room that there used to be mainframe computers in, because you could tell the floor, it was, you could pick it up the floor. And they had 4 desks in there. They didn't have room anywhere at the company at that time, so it took a while for IT to, put us in the same spot. but eventually we were going to be on the 9th floor trading floor. And I was very excited because they gave me a tour of the company, and I seen, you know, people chit-chatting and running around on the trading floor, so I was very excited. And I always liked the financial movies. So on the first day of work, he told me what I had to do. He said, so, you know, you have to print out the trading books. And he told me how to do it, and basically the printer probably used 3 inches of 3 inches of paper every day. And I had to go through this pile, and there were certain parameters that I was looking for. Basically, I was like an investigator, in a way. And the group was to make sure that the trading books were accurate, submitted on time, and there were no errors. And the areas that were overexposed had to be investigated. So we had to do this by hand at that time. And the reason why we had to do this by hand is because the investment bank industry bought out, merged together, or they bought each other out. You know, it became to a point there were only a handful of investment banks left. But their risk reporting systems were very outdated, and there were a number of risk reporting systems based on their original company. So there was no centralized risk reporting system. Today there is, because of my manager. He was hired to map out the trading books at the investment bank. So, you know, when I looked at these numbers, millions of dollars, billions, let's say, you know, I didn't get nervous. I really didn't know the seriousness of the job until probably 2 or 3 months later. Now, I did have 2 coworkers that were working in that office, and they were originally hired to do the job. But my manager, my best friend, he trusted me, and I realized why. He kept coming into the office to make sure, you know, everything was okay, and if I had any questions, etc. And he told me, don't let anyone help you. And he told them too, do not help Anthony. I thought he mentioned that because he just wanted me to learn, but I didn't realize that there was actually a reason why. And he told me the reason why years later, but at that time I didn't really know. I thought maybe he wanted me to be the face of the group. Maybe I thought maybe he wanted me to get all the exposure. I wasn't sure. But basically, once I found a trading desk, you know, profit and loss trading book that wasn't submitted, I would have to put it on a pile and call them up and to ask them to submit their data. Sometimes the person didn't show up for work. Sometimes there was many issues that they made a mistake in the computer and it made, you know, false numbers by accident. Or sometimes they forgot. It just, you know, it depends. However, in order for risk management to base their reports on those risk reports, the trading books, everything had to be submitted. And at 12 o'clock every day, all of that work had to be done. And so remember, I was also working for Asia, London, South America, you name it, all of the trading books of the investment bank. And so I did this very quickly. Sometimes I would have my coworkers call up. It just depends, you know, what I was allowed to do. It was a serious situation. And my manager, he trusted me because I was his friend, and he trusted me that I was going to do the right job, and there's a reason for that. There's a huge reason, because you can't submit the day before's data. That's against the law. And it doesn't help risk management base their reports on that information. So that's why I was hired to do the job and nobody else. Eventually, the friend of mine hired 10 computer programmers and also consultants to revamp the trading books. They bought a new mainframe computer that took up the whole room back then. You know how big they were in the late 1990s. And from there, I learned different parts of what I was doing, because eventually they used Excel sheet to automate my job. meaning it would sift through the areas that weren't reported, the areas that were overexposed, as well as the areas that there were errors. And then I would go through those that short list. I didn't have to go through the whole list, like when I had to, print that stuff out. And I would call up each area. Sometimes I would be able to send an email, etc. But in the beginning, the head traders, this is who I was dealing with, was the head traders. They didn't like the fact that I was questioning their data. They didn't like the fact that I was calling them up to submit their data. Because once people start to make a lot of money, their ego trip gets way too big. So the CEO of the company at that time sent out a memorandum to everyone at the company. And they said, if you get a message from Anthony Romano from Data Quality in risk management, you must respond to that email immediately. Well, after that memorandum, you could imagine how many calls I got. I didn't have to call anyone, they called me. And of course, my coworkers, they got jealous. There were two guys that was working next to me. Now, my friend wanted me to sit separate on the trading floor, so there was a gap between my coworkers and myself. And my friend was sitting diagonal to me so he could see my desk and who was there. A lot of coworkers and people on the trading floor, they would come over and talk to me. They liked to talk to me because I was very nice. But my friend would tell them, please don't bother Anthony while he's working. And even when my coworkers that I was working with directly would come over, he would tell them, please leave Anthony alone until at least 12 o'clock. I would get to work very early, around 3, 4 o'clock, sometimes 5, to make sure that everything was done and I was able to deal with Asia and Europe and Russia and South America and Canada, etc. So the Asian desk, they would wait, at work for me. Basically, as the job progressed, I learned what trading books look like. And eventually that system no longer became Excel, it became, it was eventually put on the website, intranet, and we had a username and password, and everything was kind of automated, but we had to check anyway, just because, you can't trust computers. Now, what was part of my job, which was very important, and it was very secret, it was to review the trading books for false information. And that's when I said I was like an investigator. Back in those days, sometimes traders would make mistakes on their losses, because remember, it was all inputted by hand. It was a very old system until after my best friend revamped the trading books, but before that, it was all done by hand. So I would question whether or not that was a $15 million loss, or was it really, less or more. It was very important to make sure that the data was 100% accurate and it was a mistake. After about a year and a half, they were done almost with revamping the trading books and creating a new risk reporting system. They used different ratios back then. And I started to question at why did risk management meet with the traders that were overexposed? It was very elementary, because shouldn't a trader know how to manage his risk, right? And that was one of my questions. And the second question was, why did they keep hiring young students from top schools who had top grades as junior traders? And they would, teach them over time to become a trader. I thought that was very elementary, and I thought it was very inefficient. It wasn't, I felt, proper for a big company like that to be hiring juniors. Yeah, we're supposed to give everyone a chance, but remember, that's a big company. And I started to realize, trading books, so who was actually making money and who wasn't. And I couldn't figure out why, for the same desk, why certain guys and girls would make a lot of money and certain ones wouldn't. And once I developed my interest in finance, I realized I was going to get a Ph.D. in, and that was financial trading at that time. That's what I thought that I wanted to do. But I experienced something very traumatic, and it affected my entire life. The entire trading desk, I can't tell you which one, they were all fired on the same day. They were all taken into a meeting. It's called Miscellaneous Meeting. And they were just fired for no reason. And it's because the top management, meaning top-down management, decided that they were going to take their money out of those markets. That's really mean to do that. And I asked my supervisor, my friend, I said to him, you know, why did they close down that desk? And he told me because they decided not to continue investing. I said, well, where did all those people go? There were like 40 people. He goes, well, they could find a new job, or they go in management, or they go on their own and they continue trading. And that's when I realized what a hedge fund was. Now, those people that were junior traders, they were typically hired from Ivy League schools, and they had the top grades. And since so many people are applying to investment banks for jobs or being recruited, they always take the best students. I thought that was very bad because I started to read about traders in history who were the best, very famous, and they didn't all have an Ivy League education. Now, later in life, while I completed my Ph.D., I noticed that there are the best traders out there. And those are people who are very visual and have a huge long-term memory. Their short-term memory isn't as good or isn't as strong. The investment bank trading desk, the recruiting process from HR, is recruiting students who have a huge short-term memory. In order to get good grades, to go to the best schools, you have to have good short-term memory on multiple choice exams, standard testing. Now, if you don't have a good, strong short-term memory, but your long-term memory is strong, then you'll probably do very bad with testing. That's really bad, because what if you were a really good trader? So the investment banks, they're limiting their businesses to a certain profile, and that profile is someone who is a manager. Strong short-term memory are managers. And they also look for, on their resume or their skills, when they recruit from HR and they go to these universities, they're looking for a dominant quality. Meaning, are they going to be a future manager? They're looking for those qualities. And that has nothing to do with being a good trader and actually making money. And that's one of the reasons why I started to realize at the investment bank that the returns weren't the same as hedge funds. They were less than what the hedge funds were doing. And if you read about it, if you listen to the media, they'll paint a picture that hedge funds are so bad, they're doing everything illegal, but that's not true. It's because the trader himself or herself went on their own. They could be day traders, they could be from all backgrounds. They don't have to have a college degree or even have, a dominant quality. This is not management. You're not telling people what to do. You're a trader. And so you have to be really visual, and you have to remember your mistakes and write them down in that book that I told you. Remember the composition book? And I knew where the industry was eventually going, because I saw the investment banks buying out each other, merging together. And I said, the larger a company gets, the less profits they are able to create, because there's less creativeness. And that's why today the hedge fund community has become what it is. They keep growing. And now, after the collapse of 08, 09, the investment banks are now allowed to invest in hedge funds. That's a major, major change in our financial world, because the investment banks realize that their risk management approach is totally outdated in today's market. If they had the best risk managers from the best schools and they had the same strategies for years, you have to say to yourself, almost all of them went bankrupt, or a handful of companies almost went bankrupt. Okay, so the government lent them a loan. They call it a bailout, the media, but it's not a bailout. The government was there to protect the economy, and they lent them money. The number one investment bank, of course, Warren Buffett, bought shares in and bailed them out, or lent them money, sorry. I hate that word, bailout. So to continue the story, so once I understood what the hedge funds were and the real story of who is behind the hedge funds, I realized that those were traders that were very, very sophisticated in making returns, because I got firsthand on seeing the trading books I can't say the name. I got firsthand seeing the trading books at the investment bank that I worked at, and that really gave me a strong foundation as to what I wanted to complete my Ph.D. in. And so after that job, it basically landed me my future, basically, in a way. And when I was working there, my friend, who was the vice president, he called up my university and he says, what could Anthony change his major to that he'll be able to take finance classes in economics? So technically, he changed my major, because I did eventually go to school and speak with the advisor. And I changed my major to social sciences. That's economics and psychology. So I did graduate, and then I started a real estate career, and I learned how to market and deal with aggressive people in a way. And I did love that career, but after that, I knew I had to go back to school. I then went on to complete an MBA in finance. I knew that if I wanted to become a doctor, I needed to study the basic foundation of finance at the MBA level. And that's where I conceptualized my Ph.D. research. I knew that I wanted to study hedge funds. After that, I got another specialization in risk management, because I worked in risk management. And it was an MBA in risk management and insurance. From there, I graduated and I started my PhD. I knew from the beginning what my topic was, and that was going to be on hedge fund selection and risk management. Because I worked for the investment bank on the trading floor, and I was the one reviewing the trading books, I had so many questions to answer. And that first job, that first experience, helped me conceptualize all these questions. I knew that the risk measures that the investment banks were using were outdated. So if they were so valuable, you have to question yourself, you have to ask the question, why did all of them almost go bankrupt? There was a handful left in the late 1990s, and they all went bankrupt. Of course, they didn't officially go bankrupt because the government lent them money to stay in business. While I was completing my PhD, a friend of mine who's a trader helped me out a great deal. She introduced me to a number of hedge fund managers firsthand, and each hedge fund manager gave me their own opinion on what I should be studying. I took those opinions with a great deal of importance. I was very thankful that they all helped me with that. And my friend, who is also a trader, she's the most loving person that anyone could ever be in this world. She continued to help me throughout my PhD research, as well as she continued to have traders give me a call and meet with me and help me with a lot of detailed stuff. During this time, I kept reading the same story that the risk measures that the investment banks use for the past 50 years were very outdated and that they don't foresee the future risks. So then the question was, well, how do you select a trader? In other words, how do you select a hedge fund? And that was the main question I had that continued to stay in my mind until I graduated. So because of the data and what well, as a PhD student, we're only allowed to use research that's within a number of years, within 5 years, I believe, as well as it had to be peer-reviewed and scholarly written by a PhD graduate or student or, postgraduate. And everything that I was reading was pointing towards a certain direction. So then I had to come up with my own theory and I had to test it out. Part of my dissertation reveals what I tested out, but part of it doesn't. Part of that is in my second book. I haven't published my second book as of today. It's done, it just hasn't been published. But my first book has been published. You could read that if you want. It's about hedge fund selection and the risk management approach to that. That was very important, all that information that I researched, because it gave me firsthand knowledge on how to select a hedge fund. Now you have to remember that the industry, the portfolio management industry comes from the investment banks, and they're using a very outdated approach to selecting hedge funds for their portfolio. You can't use the same methodology. It won't work. If you're going to try to predict and simulate how your portfolio is going to do during a market collapse, it's not going to show the true risks. Part of creating a portfolio of hedge funds is hiring, or selecting, I should say, traders that are very capable of managing their risks. Because as a trader, I had to study options and how to trade options because I had to apply my theory. And while I was an options trader, I knew firsthand, and I realized firsthand, that you have the winning trades that you don't even have to manage because they're winning, but then you have the losing trades. And that's where you have to manage. You have to manage with the risk. You have to have an approach to get out of those trades. You have to have a certain amount of money you're willing to lose. Because remember, your winning trades are easy. And so during that time, I perfected my strategy on risk management, how to manage my losing trades. I began to see the profile of a trader. Remember in the late 1990s when I worked for an investment bank? Well, from there, I saw firsthand what a trading book looks like and what the returns looks like at a trading desk, particularly a particular trader. And I questioned, of course, I mentioned before, why is it some traders make money and some don't? Why are the returns so much more in certain markets and certain trading strategies? I questioned all of that. And so I concluded that the equities market is the best market to be in. It was always going to be the best market because there's so many investments to invest in that it creates a smooth return. Other type of strategies like event-driven, unfortunately, those events may not always occur. And that's why I'm not so happy about that. So that's why the equity markets are one of the best markets to be in because there's so many people trading them. There's so many companies listed on the New York Stock Exchange or any exchange in the world. And I created my portfolio, my hypothetical portfolio of hedge funds in the equities market. And what I did notice with my data from my PhD research, I noticed that The easier and the more simpler the strategy, the better the traders did. So I realized then to stay away from very sophisticated strategies. Yes, today we have algorithms trading, but a human mind created the algorithm. And there's certain parameters that they enter and not enter. That's still a human mind. But you have to remember, it's not really a human mind when you look at the stock market as a whole. That's why the stock market is not logical, because we have computers trading, the algorithms and so forth. And that's why risk management, traditional risk management, also does not work. In addition to that, we have a global market now. We have global investors. And at any point in time, they could pull out whatever it is. And because those positions are so large, you could lose a lot of money. And that's why the risk management approach is very important. But the old way, the old portfolio management style is not effective in today's markets, particularly when you select a hedge fund. Just because someone has 20 years of a portfolio experience, that doesn't mean that they're qualified to create a hedge fund portfolio. It doesn't work like that. Remember, hedge fund managers don't have risk management on top of them, telling them what they can't do and what they can do. They are the risk manager. They are the ones that have to manage their losing trades. They're the ones that make important decisions, and they are the entrepreneurs and understand a lot about what they're doing. In addition, if they need to tweak their strategy and make it better and improve it, they do so. Whereas at the investment bank level, traders can't do what they want. And when they are losing a little too much money, they have a risk manager on top of them. That's very, very childish, to be honest with you. It's very elementary. To have another group that's separate to tell a trader how to get out of his losing trades, that's really bad. And that's another reason why I completed a Ph.D., because I knew that, a trader has to know how to manage those losses. To continue about my Ph.D. research, that was the whole premise, to how to create a portfolio of hedge funds. Today, we call it a funds of funds, or a fund of hedge funds. The reason why, though, that area has become what it is today, it's increasing. 10 years ago, it wasn't doing so well. People were going directly to hedge funds. But it's better to go invest in a funds of funds than try to find a hedge fund that you think is good. It doesn't work like that. It all has to do with risk and how that trader at the hedge fund manages his risk. Remember that, very important. For those of you who are portfolio managers and listening to this video, there's a lot more to what I say. I'm not going to tell you the whole thing. Please remember to subscribe so that you get my future videos, and please remember to thumbs up, as well as please remember to share my video with at least 5 people. And finally, please remember to send me questions to the live chat so that I could create future videos just for you. Thank you.